Welcome to Making Money Matter, a guide to financial capability with me, Tom Barrett. I'm Area Services Manager at the Charity for Civil Servants. So, learning outcomes from this presentation. So, what is financial capability? Budgeting and financial planning, savings, investing, borrowing and credit, protecting your family and possessions, managing debt, and planning for the future. So a little bit about the charity there. So our vision is a lifelong community of people offering effective support for each other when life takes a turn for the worse. And so back to the financial capability. So what is financial capability? So a little bit there. So financial capability allows you to take control, make the most of your money, and improve your life. We know that long-term pay freezes, changes in the workplace, a general rise in the cost of living, cuts to benefits, and a lack of affordable housing have had a huge impact on the people that we help here at the charity. Those who previously were perhaps just getting by are now finding it hard to cope with paying for essentials. So managing finances in this climate is more challenging than ever, but equally it's more important than ever as well. So financial capability, as we've outlined there, is quite important. So a little diagram sort of highlighting the financial capability circle, if you like. So ultimately, financial capability is about our ability to manage money, how it's influenced by our attitudes, motivations, and opportunities, as well as our skills and our knowledge. Financial capability is not just what you know, but whether you've got the willingness, the confidence, and the opportunity to act. It encompasses budgeting, planning for future financial needs, choosing financial products, and understanding financial matters such as bank accounts and interest rates. Don't worry if that sounds a little bit sort of scary. None of us are perfect at managing our finances. For even the best people out there, then there's always ways that we can improve and get better, as there is with most things in life. So making money matter. First of all, set goals. So this could be paying down a debt, saving up for a wedding, a holiday, something else that you want. I don't know, maybe a home improvement, new kitchen, whatever it might be. Make a plan. So work out what steps you need to take to achieve your goal. This could be, for example, cutting down on luxuries, putting more money away in savings, increasing your income. Take action. So once you've done the plan, don't just put it away, actually put it into practice. Seek support. So it's often helpful to get a little bit of support with putting plans into action and achieving goals. So you're actually more likely to achieve your goals if you've got a bit of support. Support can come in various forms. So it could come from family, friends, or professional support from perhaps a money advisor, or perhaps online using forums and other resources that are available. So it's important to review any plans regularly. Even the best laid plans can be thrown out by life. Obviously things change, sometimes for the better, sometimes unfortunately for the worse. Regularly reviewing the situation can help you check that you're on target and adjust your plan if needed. And it also helps you try and remain focused and to stay on track. It's after all, it's your money, so make it matter whichever way you feel most appropriate. So budgeting and financial planning. Why is budgeting important? Budgeting helps you see what money you've got coming in, helps you to keep on track, or to keep track rather of your money, ensure that your priority bills are paid, or essential bills, so gas, electric, rent, council tax, mortgages, all of those kind of things. And it helps you work out payments towards any debts as well. And it also helps you plan for the future too. So working out a personal budget. So it's useful at this point when working out a personal budget to have a pen, a paper, a calculator. before you start, grab any information that you need, so pay slips, benefit letters, pension statements, bank statements, bills and paperwork, and any info relating to any money that you owe. It might also be useful to do it, if you have a partner, do it together. So consider household finances together so that you know you're both perhaps pulling in the same direction. So drawing up the actual financial statement or your personal budget. So first of all, you've got to add up all of your income. Don't forget any contributions from other members of the household, perhaps grown-up children, that kind of thing. Note down all of your monthly expenditure. So obviously detailing all of your priority payments, like your mortgage, your bills like your gas, your electrical, the things that you need to remain comfortable and obviously keep the roof over your head. It's important when drawing up a budget to not forget the little things. So all the trips to convenience stores, the odd treat that you might buy, maybe at lunchtime. And it's also important as well to expect the unexpected. So even with the best will in the world, unfortunately things break, things need replacing. So perhaps factor in some sort of contingency for that. When you're looking at your income and your expenditure as well, often you don't realise what you're spending on certain things. So it's sometimes a good opportunity to look for savings as well. And it's also a really good opportunity as well to plan ahead and to try and get some sort of buffer in there for the things that you want to achieve or the things that you might not know are coming in the future. So when you've completed your budget, do you have any money left at the end of the month? Could you save more? Is there a budget shortfall? Do you need to cut back? Could you make any savings, for example? Could you switch fuel providers, find better mobile phone deals, shop cheaper, cook in bulk, that kind of thing? Have you considered future spending commitments such as holidays, birthdays, Christmas? Is the car going to last till next year? Will that need replacing? Could you afford to replace essential items? So, a washing machine, fridge, cooker, that sort of thing. Once you've worked out your personal budget, you can see how much, if any money you have available to pay off debts or you can put towards savings. Generally going through this kind of exercise has been shown by research to save us quite a lot of money, which can actually run into the hundreds of pounds every year. So it's a worthwhile exercise to do. So staying on budget. Keeping track of spending and sticking to a budget can obviously be quite challenging. There's a few tips really for trying to stay on budget. So you could, for example, use a spending diary, which helps you keep aware of your spending. So noting down what you're spending on a day-to-day basis and perhaps then reviewing it at the end of the month, which helps you to create a more accurate budget sometimes. Using a budgeting app, there's quite a lot of them out there. Some of them will now link into your bank account using open banking. Jam jar accounts, which are offered by some banks and quite a lot of credit unions, which is a modern twist on the old-fashioned way of separating money. So ultimately you have separate accounts for different expenditures. So you perhaps have one for essential payments, one for your housekeeping, one for your leisure, and maybe one for your savings. Use pen and paper, so keeping notes. It's old-fashioned, but it works. But ultimately, whatever you do, it's important to review it regularly, just to make sure that it's working for you. You might also want to ask yourself some questions. So, before making purchases, think about whether you need it, even can you afford it, and if you do need it and you can afford it, is it possible to find it cheaper elsewhere? Savings. Savings, small changes can eventually hopefully result in big benefits. So most people out there can make some small changes to the monthly budget, which will allow them to hopefully save a little bit of money to help deal with unexpected events, emergencies, or to save for a specific purpose. Once you've completed your budget and identified areas where you can make savings, consider how you'll make the most of them. So set a goal. So think about what's motivating you to save. are you saving for are you saving for a financial buffer to help you deal with emergencies, for example, an expected life event, so house purchase, planning for a family, a specific purchase, so to invest for the future even. So save regularly. A small sum saved regularly will soon become a much larger amount. So you could open a savings account or a similar instrument to pay into. You're less likely to dip into your savings if they're separated from your regular income. Set up a standing order so that you've got a commitment to your savings, and then also you don't forget to make your regular payment either. Pay it into an interest-bearing account as well, so that you've got interest coming on your savings, and then eventually interest starts being paid on the interest as well too. So when to save, quite important. So not at all times is it appropriate to save. So for example, if you've got outstanding credit cards, store cards, or other loans, you might want to consider these or paying these off before saving. This is because generally the interest rate on debt such as these will be higher than your interest rate on your savings, so any benefit from your savings is going to be outweighed by your debt. Where to save, so there's a variety of options available for saving, and choosing the best one for you will depend on your circumstances and what you want to achieve from your savings. For example, a savings account with a higher interest rate will usually require a longer notice period to withdraw funds. So if you need immediate access to your money, an account like this might not be suitable for you. Credit unions. So credit unions are owned by and run for their members. The members pool their savings and lend to each other. The members usually have a common interest, such as the same employer or geographical location. Any savings made by the credit union are used to improve their services or are given as dividends to the members, so as a profit. Interest rates and products available vary, so obviously you'll need to check whether this is the right option for you. Tax. So tax is payable on savings. However, new rules introduced in April 2016 give a personal allowance of up to £1,000 for basic rate taxpayers and £500 for higher rate taxpayers on the interest paid on savings. And lastly, there the Financial Services Compensation Scheme. So the Financial Services Compensation Scheme has been set up to protect savers from bank or building societies going bust, up to a maximum of £85,000 per saver. So a total of £170,000 for joint savers, and that's per authorised institution, which includes banking groups. If you have savings of more than £85,000, you'd need to spread these across different banking groups in order to protect them. So moving on to investing. Investments are something that you buy or put money into with the aim of making a profit. These fall into four main categories or asset classes. So firstly, we've got cash, which is simply money in banks or building societies. We've got fixed interest securities, which are bonds. That's basically where you loan money to companies or to governments. You've got shares, and so that's you buying a piece of that company, and property, which is investing in a physical building, so bricks and mortar investments basically. There are other types of investments as well. So for example, some people invest in foreign currency, commodities such as coffee, oil, gold. You can invest in contracts for difference, which is kind of like gambling. You're betting on whether shares gain or lose, and collectibles, so antiques, wine, art, that kind of thing. All of your investments together are referred to as a portfolio. So that's could be any of those we've mentioned above, but as I say, that the group together for one individual is their portfolio of investments. So staying on investments, so yeah, staying on investments. So risk. The risk that you run with an investment generally falls into three categories. So there's low, there's medium, and there's high. Your circumstances and risk appetite will usually determine which category you fall into, but all investments have an element of risk attached to them. For example, even a low risk cash deposit in a instant access perhaps savings account has a risk, as the interest rate paid may not keep up with inflation. So at the end your money may now actually be worth less than relatively less than when you put it in. You can spread your risk by investing your money across different products, which means that if one doesn't work out, then you've got other investments to fall back on. So when should you invest? This is obviously down to the individual, but it does depend on what your goals are generally. So if you've saved enough money to meet your household expenses for about 6 months, then you may want to consider investing any extra money that you have. So financial advisors, a financial advisor, that's somebody who advises on financial products. This could be on an independent basis, offering advice on all products available, or restricted. They'll only offer advice on a limited range of products or suppliers. A financial advisor will discuss your goals and your circumstances and offer products based on suitability. From the 31st of December 2012, the fees charged by a financial advisor must be completely clear and upfront, and there must be an agreement as to how they'll be paid in advance. Deciding on whether you appoint a financial advisor should be based on your personal circumstances and goals. If you're simply investing cash into a building society, you can probably research the best interest rates without help. However, if you're looking to invest in a more complex way, you may not feel that you have the knowledge to invest in the wisest way, and a financial advisor should be able to help you do this. So, FCA Scam Smart. The FCA have recently started a Scam Smart campaign, which allows investors to check a warning list online and has tips for being aware of the latest scams. Unfortunately, research shows that the over 55s are particularly at risk from fraudsters, as they are the group most likely to have money to invest. There's a slide there showing the FCA's promotional Scam Smart material, and at the very bottom is the website. So it's www.fca.org.uk/Scam Smart. So moving on to borrowing and credit. Most of us will have to borrow at some point in our lives, whether it's a student loan, a new car, or to buy a home. The key is to know the range of products available and how best to use them. So some types of credit. We've got secured credit, so a mortgage, a secured loan, a hire purchase agreement. They're all forms of secured credit. We've then got some examples of unsecured credit, so a personal loan, a credit card, for example, a store card, a bank overdraft, credit union, or a payday loan. You should be aware of the differences between secured and unsecured lending. Don't be tempted to clear your unsecured credit debts by taking out a secured loan, as ultimately this could put your home at risk. Hire purchase agreements for cars or household goods mean that the goods aren't owned until the full amount has been paid, and a balance may be payable even if the goods are returned back to the creditor. Before you borrow, ask yourself how much you can afford to repay each month so that you're not overstretching yourself. How long you want to pay for. So am I expecting a change in circumstances during the term of the loan? If so, how will it affect my ability to pay, and what method of payment suits me best? So comparing the cost of credit cards. So first of all, you've got the APR, the annual percentage rate. The APR takes account of the interest rate, other charges you have to pay, how long the loan agreement lasts, and the amount and timing of the repayments. Some charges, such as early repayment charges, for example, aren't included. Lenders have to tell you what the APR is before you sign an agreement. The APR does vary from lender to lender and between different types of credit. You can use the APR to compare the deals on offer. Generally, the lower APR, the better the deal, but again, shop around to find the cheapest or the best. Comparing the APR works best if you compare like with like, so the same amount repaid over the same term, basically. Variable and fixed rate interest rates. So check whether the interest rate is variable or fixed. Variable interest rates may change during the agreement. They could go up, or equally they could go down as well. Fixed interest can't be changed once the agreement is made, and the repayments, they stay the same. So costs not included in the APR might include arrangement fees or balance transfer fees, early redemption fees, higher priced goods, charges for late or missed payments. And lastly, there on the points, insurance cover, so often called PPI. This can sometimes be added to the loan, and interest is payable. Check that it's needed, and check that you could actually claim in the event that you have to, so that it's appropriate for your needs. Should remember that paying only the minimum payment on a £1,000 credit card balance would take 18.5 years to clear. So something to consider there. Borrowing, what to check when borrowing. So know your budget, shop around, check the total amount repayable, avoid borrowing to repay existing debts if possible. Beware interest-free deals. Watch out for payment holidays. Beware of variable interest. Check you could afford the rate rises if that happens, and try and avoid unplanned overdrafts. So onto credit scores. So something often asked about. Access to credit ultimately depends on your credit score. A poor credit score will mean you may not be able to get credit or can only access high rates of interest. A good credit score should give you access to some of the best deals available. You can check your credit score regularly, keep an eye on it, make sure that it's correct, so there's no misinformation on there. This enables you to take remedial action if your score's low, correct errors, and protect against fraud. There's a few ways that you can check your report. So you can check them through the 3 credit reference agencies: Experian, Equifax, and Call Credit. So things that might affect your credit score. So high levels of existing debt, for example. If you've missed payments or made late payments on anything such as fuel bills, now they can be recorded onto your credit report. County court judgments for unpaid bills, that'll seriously affect your credit rating. Applying for lots of credit at the same time can affect it. If you've moved home a lot, it can also have an impact. If you've opened but not used credit cards. Not being on the electoral register can also affect you. Being tied into joint credit with someone with a poor credit history can also impact you as well. So tips for improving your credit score: stop applying for credit until you've sorted out any problems or improved your score. Get on the electoral register, cancel any unused credit cards, pay on time or pay off early, use a credit builder prepaid card, but again, be aware of fees and things. Use a credit builder card. So unfortunately it's a high interest rate, but if you make sure that your balance is paid in full each month, that wouldn't impact you, but it'll help you improve your credit rating. Avoid expensive credit repair companies because they don't work. So moving on to something quite important: protecting yourself, your family, and your possessions. You know, we just don't know what life's going to throw at us. How would your family cope if you were hit with an unexpected cost, for example? If you lost your job through sickness or redundancy, could you have managed financially? In truth, for many of us, the answer to this is no. Unfortunately, we couldn't manage. So how do you protect the things that are important to you and your family? So first of all, you need to know your budget. Knowing exactly what's coming in, what's going out, will help you to keep track of essential spending and allow you to make cuts where necessary. Paying off debt. So paying off debts when you can do to ready yourself, unfortunately, for the negative events. So I mean, in today's society, most people will have some debts like credit cards, car loans, and mortgages. These things will still need to be paid even if you have a drop in income. It's a really good idea to plan to pay off debts you have. If you can, pay a little bit more off per month. And if you need credit, try to avoid borrowing more than you need. If you do find that you can't manage your debts, make sure that you get good advice as soon as you can. So using savings as protection, work towards having at least 3 months worth of essential living expenses in savings so that you can cover your costs and keep stress levels down if you're faced with a crisis. It'll give you some much needed breathing space while you think about your next steps. Think about as well what items are essential for your family. It could be that you can't live without a washing machine, or for example the car if you've got to travel distances. Keep a small pot of money aside to cover repairs for those kind of things, and that'll also give you less to worry about as well. Insurance, lastly, so you can insure most things in life. So obviously your car, which is common to most people, your life, your home contents, buildings, personal accident, travel, mobile phone, gadget insurance, pet insurance, bike insurance, get product warranties. So for your white goods, for example, rent guarantee, payment protection insurance. So, I mean, obviously the type that you buy will depend on your circumstances and the cost of whatever you're buying. Decide what product or service and the level of cover you need before you buy, and obviously compare it from different providers to make sure that you are getting the best deal. So, excuse me, managing debt. So most of us are managing debt, as we've said, in some way, but it's important that these are paid off in the right order. Some debts are a priority because of the consequences of not paying them, and those consequences tend to be far more serious than for others. So, for example, rent, mortgage could result in homelessness. Council tax, fuel arrears can result in quite serious enforcement. So always make sure that you pay your priority debts first before any what we call consumer credit debts, so things like credit cards. Use savings to pay down debt. Interest on debt, as we've said previously, is likely to be higher than interest on savings. Stop borrowing. Borrowing money to clear existing debts is very seldom, or is seldom, the answer. And seek advice. If you feel that your debts are becoming unmanageable, seek advice early. There's lots of options available to help you manage your debts. Use free advice agencies where possible, and don't forget that charity obviously has its own money advice and guidance service. Contact us, obviously, if you'd like to inquire about that. Planning for the future. So moving the slides on. Planning for the future. So work out your retirement income. Most people choose to save for their retirement by contributing to a pension scheme. There's 3 types of pension scheme. So there's, first of all, the one that most commonly is heard of, the state pension. This is paid by the government and is based on national insurance contributions. The rules for state pension did change in April 2016, and it's now paid based on a full contribution of 35 years. If you're a woman born after 1953 or a man born after 1951, you'll fall under the new scheme. The old rules still apply to those born before these dates. You can check your national insurance record at gov.uk, and remember that you don't have to be working to earn national insurance credits. If you receive certain benefits, you'll have earned credits as well. So there's then a defined contribution pension. So this type of pension is based on contribution from you or your employer and any investment returns. If you have this type of pension and you're over 55, you may be able to draw down some of your pension pot. There's then also what's called a defined benefit pension, and this is a salary related pension which pays out a secure income which increases each year. How much you receive is based on how much you earn and how long you've been paying into the scheme. So just a little bit there about what we offer individuals here at the charity. So we offer or other sort of support we can offer, so supportive wellbeing conversations, assistance on deciding where to go for the best advice, information and practical help, a route to specialist charities and services where appropriate, help for managers and supporting those who need it, and then we partner with various other organisations such as Anxiety UK, the Money Advice Service, Relate Northern Ireland, Relationship Scotland, National Deadline, the National Autistic Society, and also Law Express. Unfortunately, we can't offer guaranteed solutions to all problems, and neither can we offer what we call replacement services. So we can't replace services that should be provided by councils under statutory obligation, for example. So other services there: financial assistance, relationship advice or assistance with relationships, caring, legal advice via Law Express, a partner organisation, and wellbeing services as well. So lastly, there is our contact details. Now, as it's Talk Money Week, the charity have been working on some new resources. So firstly, we've developed JaneBot, which is a fun interactive chatbot. JaneBot has access to a whole host of information, digital tools, calculators, videos and downloads to help you make the most of your money. Next, we've put together an e-learning module for you to try out so you can test your knowledge and find out more about key issues such as retirement, insurance and budgeting. And finally, we've partnered with Law Express and the Money Advice Service to update our free smartphone app with lots of practical help and advice on a range of issues, including debt, housing and family issues. You can find all of these or more by visiting our website at www.foryoubyou.org.uk/FinCap. And as you've hopefully enjoyed this webinar, why not join us for more on the 30th of November between 11 AM and 12 PM. We'll have a Carers Rights Day special, caring for carers and their managers. And the 12th of December between 3 PM and 4 PM, we'll be having a webinar on looking after your wellbeing. And if you have any thoughts, comments or ideas about our webinars, then you can email us directly at webinar@foryoubyou.org.uk. That's great. Thanks for your attendance today, and hopefully hear from you soon.